Where does money really come from? Let me tell you something straight, something very few people ever say out loud. Money does not come from labor. It does not come from gold, and it definitely does not come from real value. Money comes from trust that has been legalized. Once upon a time, money was gold and silver. You could hold it, touch it, count it. But as societies grew more complex, a dangerous realization emerged. Whoever controls the ledger no longer needs to control the gold. Modern money is born in a very simple moment, the moment a debt is recorded inside the system. When a bank lends you money, it doesn't hand you something that already existed, it creates new money with a number on a screen. Accounting entry first, money second. You sign a contract. The bank types a few lines into a system, and just like that, money is born. No new paper needs to be printed. No new gold needs to be mined. All it takes is a signature in a legal framework that guarantees the right to collect. That's why money is not a physical object. Money is power, standardized. You work your entire life to earn money, while someone else only needs the authority to issue debt to create it. That's why people at the bottom are taught to believe money is scarce, and people at the top know the truth. Money is only scarce for those who don't have the right to create it. Why are banks richer than governments? Because governments spend money, while banks create it. That's the difference no one teaches you in school. A government must collect taxes before it can spend. If taxes aren't enough, it must borrow. And when it borrows from the very system that creates money. Banks don't wait for revenue. They don't need approval from voters. They don't face election cycles. They operate in a different dimension of power. When a government runs a deficit, it's considered irresponsible. When a bank expands credit, it's called growth. Same action, different status. Governments are trapped inside budgets. Banks design the budgets. Every time a government issues bonds, it's admitting something quietly. It does not control the source of money. It only controls how to distribute what it can access. And here's the part most people miss. Governments change, presidents come and go, parliaments rise and fall, but banks remain. They outlive political systems because they're not tied to popularity, they're tied to contracts. A government can default. A bank restructures. A government collapses. The banking system gets bailed out. Why? Because the system treats governments as clients, not as masters. When a crisis hits, governments go on television. They ask for patience. They explain sacrifices. Banks go into closed rooms. They negotiate terms. And the terms always protect the structure first. That's why banks don't need to rule openly. They let governments take the blame. They let politicians argue on screens. Real power doesn't argue, it invoices. Why do wars really begin in boardrooms, not on battlefields? Because battlefields are only where decisions are executed. Boardrooms are where decisions are made. No war ever begins with gunfire. It begins with reports, numbers, and scenarios presented behind closed doors. There is no emotion in that room, only interests, risks, and expected returns. When people talk about war, they talk about soldiers, weapons, territory, but the people who actually start the game look at something else: cash flow, resources, supply chains, long-term control. Inside boardrooms, war is given harmless names: regional stability, protecting strategic interests, restructuring order. No one says killing. No one says destruction, because in that room, war is not a tragedy, it's a tool. Battlefields appear after all calculations are finished. Who benefits if the conflict drags on? Who loses if it ends too soon? Who sells the weapons? Who finances the reconstruction? Who controls the debt afterward? It's no coincidence that war is always followed by debt. A destroyed nation doesn't just lose buildings, it loses financial sovereignty. And that's when the people who never fired a single shot step in. They bring contracts, they bring conditions, they bring money, but money with strings attached. The war may end on maps, but it truly begins inside the financial system. Because when you can control cash flow, you don't need to occupy land. Others will do it for you. Battlefields create images. Boardrooms create outcomes. Soldiers die on the front lines. Profits are divided in silence. And that's why the most powerful people in the world never appear on the battlefield. They don't need to. The rise of private banking. Private banking didn't emerge to serve society. It emerged to solve a power problem. In the old world, kings controlled money. Whoever had gold commanded armies. Whoever commanded armies made the rules. But that kind of power had a fatal weakness. War drains treasuries faster than anything else, and no empire ever had enough gold to fight forever. As warfare became more expensive, a new solution appeared. Not printing more money, not raising more taxes, but borrowing. At first, wealthy merchants lent money to kings. In return, they received privileges, the right to collect taxes, monopolies over trade, immunity from the rules that governed ordinary people. From that moment, power began to shift, not on the battlefield, but inside the debt ledger. Once a king borrowed, he became a debtor, and a debtor is never truly free. Private banks were born at this intersection, between war and finance, between political power and monetary power. They didn't need thrones, they didn't need armies, they only needed contracts protected by law. Over time, the model evolved. Banks didn't just lend gold, they lent certificates of gold, then numbers representing money that never physically existed. And here came the turning point. Banks realized they didn't need to possess all the money they lent. They only needed enough trust. As long as borrowers believed, as long as the state enforced repayment, as long as society accepted paper and numbers as money. That's when private banks became factories of money. No declarations, no votes, just quiet operations inside legal frameworks. While kings rose and fell, banks survived dynasties. Governments came and went, banks stayed. They learned never to stand on the front lines. They stayed behind, financing both sides when necessary. No history book lists them as victors, yet no major conflict has ever occurred without their fingerprints in the accounts. Private banks understand one simple rule: whoever controls debt controls the future. And the moment society accepted that, power no longer belonged to the ruler, but to the one who financed the ruler. The role of interest rates and public debt. If the power to create money is power itself, then interest rates are the steering wheel, and public debt is the rope that ties an entire nation to the direction that wheel turns. Interest rates are not just numbers, they are signals of control. Raise them slightly and the economy slows. Lower them slightly and money floods everywhere. Businesses expand, bubbles form, risk is pushed into the future. People believe interest rates reflect the market. Those at the top know better. Interest rates are a tool for shaping behavior. When rates are low, people borrow. When rates are high, people freeze. And fear is the most efficient form of control. Public debt begins as a temporary solution. War, crisis, disaster. But nothing is more permanent than something designed to last forever. Once a government becomes accustomed to borrowing in order to function, debt repayment becomes the top priority. Not welfare, not education, not long-term vision. Pay the debt first. From that moment on, national policy is no longer free. It must serve the ability to pay interest. Whoever controls interest rates controls the budget. Whoever controls the budget controls policy. And whoever controls policy controls society without ever stepping into the spotlight. Public debt does not need to be fully repaid. It only needs to never be erased. Because a nation without debt is difficult to control. A nation trapped in perpetual debt must listen. When crisis strikes, the answer is always the same. Cut rates, inject liquidity, borrow more. Each time the system grows deeper, not collapsing, but never escaping. The public sees relief, those at the top see expanded control. Interest rates decide who survives a crisis. Those with cheap capital acquire assets. Those without capital lose them. The wealth gap is not an accident. It is the long-term result of monetary policy. Public debt turns the future into collateral for the present. Generations not yet born inherit interest obligations. And the most dangerous part? When society begins to accept this as normal. When people believe that debt is inevitable, when they believe there is no alternative, that's when power reaches its perfect form. No force required, no repression needed, just a silent adjustment of an interest rate. Why the power to issue money is the ultimate form of power? Because every other form of power eventually has to be converted into money. You can have an army, but an army needs payroll. You can have laws, but laws require budgets to be enforced. You can have a government, but a government cannot exist without cash flow. The power to issue money stands above it all. Whoever issues money defines economic reality. They decide what has value, what gets funded, what gets starved. When you control the source of money, you don't need to give orders. The system adjusts itself in your favor. Issuing money doesn't just create a medium of exchange, it creates the priority order of society. Industries that receive capital grow. Industries that don't slowly die. People don't need to be forced. They move toward where the money flows. That's the most refined form of power. No coercion, no violence, yet absolute. When money is issued through debt, the issuer doesn't just create money, they create obligation. Money enters the economy, debt remains. And that obligation forces society to operate under a single logic: grow fast enough to service interest. If growth fails, the system begins to purge. Weak businesses are eliminated, workers lose jobs, assets change hands. Not because of morality, but because of mechanism. The issuer of money doesn't need to pick winners. They only need to design the rules. The rules will choose for them. Ultimate power lies here. You can alter the future without changing the present. Adjust the speed of issuance, adjust the conditions of access to money, and the entire society shifts direction. Governments may argue, parliaments may vote, citizens may protest, but if cash flow doesn't change, neither does the outcome. Because politics is the surface, money is the foundation. Those who control money issuance don't need public visibility. They don't need to be loved. They don't need to win elections. They only need the system to believe that the currency holds value. Once that belief is maintained, power becomes invisible but impossible to resist. That's why throughout history, every major revolution has revolved around money. Not slogans, not leaders, but who controls the issuance of money after the smoke clears. You can change regimes, you can rewrite constitutions, but if you don't change the source of money, you only change the managers, not the power. And that's the final question very few societies dare to confront. Who has the right to create money, and why?
Follow, subscribe, and share the channel to gain new knowledge and grow every day. If you really want to understand how the world works, don't look at politics. Don't look at elections, and don't listen to the speeches they put on television. Look at money. Not the money in your pocket, but who creates it, who controls its supply, and who benefits when it loses value. That's where real power lives. People are taught that money was created to make trade easier. One man had grain, another had meat, and society needed a medium of exchange. It sounds reasonable. But it's not how history actually played out. For most of human history, money was never invented by the people. It was imposed from the top down, by kings, by emperors, by governments, and later by financial powers standing behind governments. Money wasn't created for convenience. It was created to collect taxes, to pay armies, and to maintain control. From the very beginning, money was a political weapon long before it became an economic tool. In the early days, money was tied to something real: gold, silver, precious metals. Its value came from the material itself. But a problem emerged very quickly. Who held the gold? Not the people. Power always controlled the vaults, and once you hold everyone's gold, you discover a dangerous truth. No one actually checks whether it's all there. They just need to believe it is. From that moment on, money began to separate from real value and attach itself to something stronger than gold: forced trust. Banks didn't start as financial empires. They were simple gold custodians. People deposited gold and received paper receipts. At first, those papers only proved ownership. Over time, they began circulating directly as money. Then came the discovery that changed everything. Not everyone comes to withdraw their gold at the same time. In that moment, banks realized they could issue more paper than the gold they actually held. That's when money began to be created out of nothing. No mining, no production, just numbers written into a ledger. That was the birth of monetary power. Once money is created as debt, interest becomes inevitable. And here's the fatal flaw: the principal is created, the interest is not. That means the system is permanently short of money. Someone always has to fail. When borrowers can't pay, assets are seized. And who ends up owning those assets? The lenders. This wasn't an accident. It was designed this way. Interest isn't just the price of money. It's a machine that transfers wealth from the many to the few, legally, quietly, and continuously. At first, individuals borrowed, then merchants, then corporations, eventually governments. Wars cost money, social programs cost money, governments cost money. When taxes aren't enough, governments borrow. And they don't borrow from their citizens, they borrow from the financial system. The moment a government depends on debt, its sovereignty begins to erode, because whoever controls the flow of money controls policy. You can have a flag, an anthem, and a constitution, but if your budget depends on debt, you don't truly run your own country. People believe parliaments hold the highest power, that laws shape society, but laws mean nothing without money to enforce them. Armies need salaries, police need funding, systems need capital. The ones who control the money decide what actually happens. History's most effective coups weren't carried out with guns, they were executed through finance. You don't need to overthrow a government, you just shut off its funding. People hate taxes. Taxes cause outrage, but there's one tax that requires no vote, no announcement, no explanation: inflation. When the money supply expands, purchasing power shrinks. You lose wealth every day, but you don't know who took it. Inflation is how financial power pays for wars, crises, and policy failures without asking anyone's permission. It's the most sophisticated tax ever invented. One of the biggest lies of the modern world is that money is neutral. There is no such thing as neutral money. Money always serves its creator first. Those who receive it early get richer. Those who receive it last pay the price through inflation. That's why the rich keep getting richer while wage earners fall behind. Not because they're lazy, because of how money enters the system. Once you understand money, you understand why wars never stop. Wars aren't just about land or religion or ideology. Wars need money, and money feeds on war. War justifies debt. Crisis justifies money printing. And in the chaos, assets are redistributed. Those who prepared buy cheap. Those who don't understand what's happening lose everything. If you've listened this far, keep one question in your mind. If money is power, why aren't the people who create it held accountable like governments? That question leads us deeper, to where monetary power hides behind complex structures and names the public rarely sees. Once money is separated from real value, and the power to create it no longer belongs to society, a larger question emerges. Who stands between money and power? Who can remain invisible while controlling the entire system? The answer is not governments. It is not armies. It lies in the middle layer, where money is created, distributed, and withdrawn. That is where banks move beyond service providers and become the operators of the game. Banks don't need force to rule. They control the economy's breathing. When money is cheap, they flood the system, stimulate growth, and create the illusion of prosperity. When money becomes expensive, they tighten credit, choke liquidity, and watch businesses collapse and assets get sold off. The public sees economic cycles. Insiders see execution. From that moment on, the economy no longer runs naturally. It runs on credit cycles. And those cycles are not random. They are adjusted through interest rates, lending limits, and decisions most of society never gets to participate in. Interest rates become the master dial. Turn it slightly, money slows. Turn it the other way, bubbles form. People see outcomes. They never see the hand turning the dial. When growth happens, they credit policy. When collapse comes, they call it an accident. In finance, accidents are rare. As debt expands, society gets locked into the future. You're not just working for today, you're working to pay for decisions made long before you understood the game. Debt turns time into an asset. Whoever controls debt controls the future. That's why sovereign debt becomes a strategic weapon. A nation doesn't need to be invaded to lose independence. It only needs to be pulled into a borrowing spiral. First to develop, then to sustain, finally to survive. When most of a national budget goes to servicing interest, political decisions are no longer free. There are no real choices left, only less painful options. In this system, banks don't issue commands, they set conditions. Conditions for loans, conditions for refinancing, conditions for bailouts. And every condition comes with a concession. Bit by bit, power shifts without any announcement. The public rarely notices because the process is slow. There's no single day of collapse, no official moment of loss, just living standards eroding, taxes rising, opportunities shrinking. And when people look back, they can't explain why they work harder yet feel poorer. Part of monetary power lies in complexity. The system is designed to be just confusing enough that ordinary people can't track it. Financial jargon, derivatives, credit instruments all act as a curtain. Behind that curtain, the most important decisions are made without public consent. Complexity isn't accidental, it's protection. When people don't understand, they don't resist. When they don't resist, the system continues. And by the time they realize what happened, everything has already been signed. The media talks about growth, markets, and indexes. They rarely talk about the power structure underneath, because monetary power dislikes light. It works best in darkness, where everything is framed as technical necessity, not moral choice. When a crisis hits, society is told it was unavoidable. But every crisis has beneficiaries. Assets don't disappear, they change hands. In every collapse, those holding cash buy cheap, and cash always concentrates in the same places before a crisis. People sell out of fear. The system buys because it prepared. That's the difference between players and pieces. Pieces react, players anticipate, and the system's architects are always one move ahead. When governments face crisis, they return to the only place that can save them, the financial system. In exchange, they surrender more authority, more control, more dependence. Every bailout comes with a price paid by future generations. People often ask why major financial failures are rarely punished. The answer is simple. The system doesn't see them as failures. They're operating costs. When profits are privatized and losses are socialized, risk stops being a constraint. And without real risk, behavior repeats, bubble after bubble, crisis after crisis, each larger than the last, each more destructive, yet the power structure remains intact. The most dangerous condition isn't poverty, it's not knowing why you're poor. When people believe everything comes down to personal effort, they stop questioning the system. And when they stop questioning, the system never needs to change. Money doesn't just shape economies, it shapes thought. It defines what is considered reasonable and what is labeled extreme. Questions about who creates money are often dismissed as unrealistic or dangerous, not because they're wrong, but because they threaten the foundation. When a society accepts that money must be created through debt, it also accepts scarcity as normal, relentless competition as inevitable, inequality as natural. But these aren't natural laws, they are design outcomes. In this world, freedom isn't taken by force, it's eroded by financial obligation. You voluntarily work more to service debt. You voluntarily accept risk to survive, and you call it choice. Look deeper and you'll see that monetary power doesn't need visibility. It doesn't need elections. It doesn't need speeches. It only needs to ensure there are no alternatives outside the system. And when there are no alternatives, compliance becomes invisible. All of this leads to one central point. When monetary power grows large enough, it no longer needs to control individuals. It only needs to control the rules. And once the rules are set, everyone plays whether they want to or not. In the next part, we go deeper, to where monetary power doesn't just influence economies, but shapes history, war, and global order, where money stops being a tool and becomes a weapon. When you step back and look at the entire picture from above, one truth becomes hard to ignore. Monetary power doesn't operate through brute force. It operates through structure. And once that structure is built deep enough, no one needs to give orders anymore. Society moves automatically along a path that was designed long ago. At the deepest level, power is no longer about who has more money. It's about who defines what money is. When money is defined as something that can only exist through debt, the entire society becomes locked into a single logic. To survive, you must borrow. To grow, you must borrow more. And when borrowing is no longer possible, the system quietly eliminates the weakest players. At that point, money stops being a tool. It becomes the rules of the game. And rules don't ask for permission. You either follow them or you're removed from the board. Monetary power is strongest when it's invisible, when no one can clearly point to it, when people believe this is simply how the world works, not a set of choices made by human beings. Once you accept there are no alternatives, you stop trying to change anything. You focus on adapting. This system doesn't require majority approval. It only requires silence. And silence is purchased with temporary stability. As long as money keeps flowing and daily life continues, the deeper questions are postponed. People stay busy living, busy paying debts, busy chasing short-term goals, with no energy left to examine long-term structures. When major disruptions occur, society doesn't question the foundation. It searches for fast solutions, bailouts, stimulus, more money printing. And each time this happens, the system gains another layer of reinforcement, like repairing a dam by increasing pressure behind it. Dangerous, but not an immediate collapse. And so people continue believing the method works. On the global level, monetary power doesn't need armies to dominate. It rules through standards. Monetary standards, financial standards, credit standards. Any nation that refuses to comply is quietly cut off from trade, investment, and liquidity. No public sanctions required, just a change in access conditions. That's why many countries appear independent on paper, yet remain tightly bound by invisible constraints. They can hold elections, they can change leaders, but they can't change financial direction without paying an immediate price. When money becomes the world's common language, whoever controls that language controls the conversation. The most important decisions are never made in public forums, but behind closed doors, where risk is calculated with models, not social consequences. And because everything is framed as technical necessity, as unavoidable, responsibility gets diluted. No one is ultimately accountable. Everyone is just doing their job inside the system. But the system itself has no ethics. It only optimizes for its own survival. At this stage, monetary power doesn't need to suppress free speech. It only needs to redirect attention. Media focuses on surface-level conflicts. Politics divides society into opposing camps. Meanwhile, the core structure remains untouched. People fight over outcomes, while the rules of the game are never discussed.
That's when power reaches its most stable form, when those most affected turn against each other instead of looking upward. At an even deeper level, money doesn't just shape economies or politics, it shapes values. It defines success and failure. It determines who deserves admiration and who is labeled a loser. When everything is measured in money, anything that can't be priced gets pushed aside. People begin trading time for income, health for stability, freedom for security, and they call it maturity. But very few can point to the moment they consciously agreed to these rules. They only realize they've been inside the system for a long time. The system doesn't need to be perfect. It only needs to function well enough not to collapse immediately. Gaps, injustices, and inequality are treated as acceptable costs. As long as the whole keeps running, individual losses are dismissed as personal problems. And when someone tries to step outside the framework, they're quickly pulled back in, not through violence, but through reality. No access to capital, no access to markets, no access to liquidity. The modern world is built around money, and anyone who refuses its rules becomes isolated. Here's the critical realization. Monetary power doesn't require your belief. It only requires your participation. You can disagree, you can criticize, but as long as you need money to live, you remain inside the system. The only difference is awareness. Those who don't understand react. Those who understand prepare. And those who design the system are always ahead of both. When you study history, you'll notice empires don't fall because they lack resources. They fall because they lose control of money. When currency collapses, when debt becomes unmanageable, when trust erodes, military strength and culture can't save them. Every time an old order weakens, a new one emerges. But one thing remains constant. Monetary power always finds a way to stay at the center. It may change form, change language, change tools, but its essence remains the same. At this point, the goal isn't to decide who's right or wrong. The goal is to see the structure. Once you see the structure, crises no longer surprise you. Volatility no longer causes panic. You understand that what's happening isn't random, it's consequential. And once you understand that, new questions arise. Not the questions the system encourages, but the ones that touch the foundation. Who has the right to create money? Who benefits from its creation? And what the true cost of stability really is. The answers don't fit inside a single video. But asking the questions already moves you beyond the role of a pawn. You may still be on the board, but now you can see the hand of the player. And that's where this chapter ends. Before talking about war, global crises, or major collisions between monetary systems, the foundation has to be understood, because every conflict above begins with structures below. Money isn't just a medium of exchange, it's an architecture of power. And once you see that architecture, the world is never simple again.
Follow, subscribe, and share the channel to gain new knowledge and grow every day. The rise of financial dynasties. The names you don't see in the headlines. When people talk about power, they usually point to presidents, prime ministers, parliaments, or faces that appear on television every day. But real power rarely needs a spotlight. It doesn't need elections. It doesn't need approval. It only needs to exist long enough and deep enough to shape the rules of the game. In modern financial history, there are families who never held political office, never ruled nations in the traditional sense, yet influenced the flow of money, war, public debt, and the fate of empires. The Rothschild family is one of those names. What matters is not how rich they became, but how they built power, quietly, across borders, and in a way that was nearly impossible to replace. This family did not rise by inventing a product. They did not conquer land. They rose by controlling capital flows at moments when Europe was tearing itself apart through war and crisis. It didn't begin in palaces. It began in a crowded Jewish quarter in Frankfurt with a man named Mayer Amschel Rothschild. He wasn't nobility, he wasn't a general. He was someone who understood one thing most of the world had not yet realized.
Whoever controls financial information and credit controls the future. Instead of building a single bank, Mayer Amschel did something far more strategic. He decentralized the family's power across multiple financial capitals. His 5 sons were sent to 5 key cities: Frankfurt, London, Paris, Vienna, and Naples. Each son wasn't just a representative, he was a command node in a cross-border financial network. They were connected through letters, codes, and absolute family loyalty. While nations were divided by borders and war, the Rothschild network operated as a single organism. This is the critical point. When governments needed money to fund wars, they couldn't wait for taxes. They needed capital immediately, and the Rothschilds provided it. Money doesn't fire bullets, but it decides who gets to buy them. During Europe's wars of the 18th and 19th centuries, especially the conflicts surrounding Napoleon, the family didn't pick sides based on ideology or patriotism. They sided with cash flow. They lent money, moved gold, guaranteed war bonds, and handled international payments. If a government won, it paid its debts. If a government lost, it still paid its debts, just under different terms. Either way, the debt survived, and the lender kept their position. That's the fundamental difference between military power and financial power. Armies can be defeated, territory can be occupied, but debt doesn't disappear when the battlefield goes quiet. It follows the economy into the post-war period and shapes policy for decades. The Rothschilds understood this early. They didn't seek to control governments, they made governments dependent. This dependency didn't require force, it was built on efficiency. Once the Rothschilds proved they could raise capital faster, cheaper, and more reliably than any alternative, governments stopped having real choices. Another critical detail often overlooked: the Rothschilds weren't just lenders, they were information brokers. Before the internet, before global telegraphs, receiving news days earlier could create massive advantage. Their family network gave them early access to battlefield updates, political shifts, and financial conditions, often before governments themselves. Information became an asset. Money followed information. Their power didn't come from crude market manipulation. It came from designing a system where they became an indispensable intermediary. If money needed to move across borders, they were there. If governments needed to issue bonds, they underwrote them. If gold needed secure transport, they arranged it. When you sit in the middle of every major transaction, you don't need to issue commands, you only adjust terms. This creates a form of power far more refined than traditional political authority. No speeches, no decrees, just interest rates, maturities, and conditions. A government can talk about sovereignty, but when the treasury is empty, sovereignty negotiates with capital. The Rothschilds also understood the value of staying invisible. Unlike modern billionaires who chase publicity, their influence relied on discretion. The less attention they attracted, the harder they were to attack politically. In many periods, the Rothschild name barely appeared in official records, even while they stood behind the largest financial operations in Europe. This wasn't coincidence, it was strategy. Sustainable power doesn't need public recognition. Another key factor was how they preserved power across generations. Instead of fragmenting wealth like many rich families, they maintained tight family structures, internal marriages, and centralized control. The goal wasn't fame, it was continuity. They didn't chase short-term profit. They focused on long-term positioning inside the financial system. That allowed them to survive revolutions, regime changes, and economic collapses. Empires fell, debt remained. And where debt exists, financial power follows. The Rothschilds never needed to rule a nation. They only needed to ensure that whoever ruled would need credit. This is a model of power rarely acknowledged in surface-level history. We're taught about kings, battles, treaties. We're rarely taught to ask, who paid for all of it? The answer is usually not in textbooks. It's not on front pages. It's in ledgers, loan contracts, and cross-border financial networks. The Rothschild family was not the only one, but they were the earliest and clearest example of modern financial power, a form of influence that needs no army, no flag, yet can shape the fate of millions through decisions that appear invisible. Once you understand this, history looks different. Not who won the war, but who financed it. Not who took office, but who funded the machine that kept it running. And this is only the beginning of the story of financial dynasties.
The rise of financial dynasties, the names that never make the headlines. European and American financial tycoons, Part 1. When people talk about global power, they usually look toward nations, political institutions, and leaders who appear before the public. But behind that visible layer exists another level of power, quieter, more durable, and far harder to replace. This is the power of financial tycoons. These are not wealthy individuals in the ordinary sense. They do not merely own assets. They control the direction of capital, credit, and risk on a national and transnational scale. They do not need to govern. Governments adapt to the financial conditions they set. In Europe and the United States, this class of financial power rose alongside modern capitalism itself. But unlike industrial entrepreneurs, they did not create value by producing goods. They created power by controlling capital. What unites these financial dynasties is not nationality, but mindset. They see the world not as a political map, but as a massive balance sheet. To them, a nation is not a symbol of sovereignty. It is a financial entity with revenue, expenses, debt, and default risk. During the 19th and early 20th centuries, as nations industrialized at breakneck speed, the demand for capital far exceeded internal savings. Railways, factories, wars, urban expansion all required money long before they produced returns. That gap is where financial tycoons stepped in. Unlike politicians, they did not need speeches. Unlike armies, they did not need weapons. Their tools were credit, interest rates, guarantees, and time. In Europe, financial power developed in an environment of constant imperial competition. War was not just a military conflict, it was a financial equation. Whoever could sustain cash flow the longest held the advantage. And at that point, financial tycoons became indispensable partners of the state. They were not on the battlefield, but they decided who could stay on it. In the United States, the context was different. There were no ancient dynasties, but there was a rapidly expanding financial market. The rise of banking, bond markets, and later stock exchanges gave birth to a new class, those who did not produce but allocated capital. This is where American financial tycoons emerged. They did not need noble titles. What they needed was access to large pools of capital and the ability to shape market confidence. Confidence is the core asset of finance. When markets believe an individual or institution can underwrite, mobilize, or stabilize capital, power concentrates automatically. No law needs to grant it. The market does it voluntarily. This is where financial power becomes both dangerous and sophisticated. Because it is unofficial, it is difficult to regulate. Financial tycoons do not face direct political accountability, yet their decisions can affect millions of lives. When they withdraw capital, economies contract. When they flood markets with capital, bubbles form. No announcement is required, only a shift in cash flow. Another shared trait of European and American financial elites is that they rarely operate as isolated individuals. Their power is embedded in institutions, investment banks, trust funds, insurance companies, or tightly connected family networks. This structure provides protection. When crises occur, individuals hide behind institutions. When investigations arise, responsibility is dispersed enough that no single actor holds the whole burden. On the surface, they are businessmen. At a deeper level, they are architects of the financial system. They understand that money does not need to remain in their possession. What matters is the authority to decide where it goes, when it moves, and under what conditions. Ownership is static. Control is dynamic. That's why many financial tycoons do not hoard cash. They keep money in constant motion through loans, bonds, and strategic investments. Each cycle multiplies influence beyond the original amount. A dollar lent at the right moment can determine the fate of a company, an industry, or even a nation. European and American financial elites also learned early that lasting power does not come from confronting governments, but from becoming indispensable partners. When states need funding, they step in. When economies collapse, they stabilize the market. In return, they gain policy influence, legal privileges, and, most importantly, early access to information. In finance, information is not just data, it is time advantage. Knowing about an interest rate decision, a bailout, or a regulatory shift even days in advance can generate massive profit. And that profit does not come from labor, it comes from position. This class rarely speaks about power. They speak about markets, stability, confidence, and growth. But behind these neutral terms are decisions that shape society at a deep structural level. When capital flows into finance faster than production, economies change form. When debt grows faster than income, societies become fragile. But these consequences often appear years later, long before the decision-makers have moved on. That is the defining feature of financial power: delay. European and American financial elites did not build dominance through a single dramatic move, but through thousands of small, legal, and reasonable decisions made over time. Only in hindsight does the full picture become clear. And once that picture emerges, the system is already too large to reverse easily. This is only the foundation. In the next sections, the focus will move deeper into specific groups, specific mechanisms, and the ways financial dynasties shape the modern world without ever stepping into the public eye. Follow, subscribe, and share the channel to gain new knowledge and grow every day. The Rise of Financial Dynasties. The names that never make the headlines. European and American Financial Tycoons. Part 2. If the previous section laid the foundation for the rise of financial elites, this section moves deeper into how their power actually operates, not through dramatic moves, but through a series of small, legal, reasonable actions that compound over time into structural dominance. The first thing to understand is this: financial tycoons do not think in political cycles. They think in long financial cycles. 4-year elections mean very little to them. What matters are debt cycles, interest rate cycles, crisis cycles, and restructuring phases. Within these cycles, crises are not disasters. Crises are moments of asset redistribution. When the economy grows steadily, profits are spread more evenly and power becomes diluted. But when crises hit, liquidity disappears, debts are called in, and those without capital are forced to sell assets at distressed prices. This is when financial power concentrates. Financial elites understand this deeply. They do not fight crises, they prepare for them. Preparation does not mean deliberately triggering a crisis. It means positioning yourself to hold liquidity when others don't. When the market needs cash the most, they are the ones who have it. Liquidity at the right moment is worth far more than paper profits during boom times. In Europe, financial tycoons are often tightly connected to long-established banking systems, insurance institutions, and government bond markets. They understand that states do not default in the traditional sense, but they can lose payment capacity. And when that happens, bondholders and creditors gain more influence than voters. When a government needs refinancing, it does not negotiate as a fully sovereign power. It negotiates as a massive debtor. The language changes. Power shifts. In the United States, the mechanism is more sophisticated. Instead of directly lending to the state, financial power operates through markets. Treasury bonds, repo markets, and institutions deemed too big to fail form a dense network where government and private finance are deeply intertwined. Within this network, financial tycoons rarely appear as individuals. They operate through institutions, funds, and investment banks. When a major institution faces collapse, the question is not whether it will be rescued, but how and who benefits. The answer is rarely moral. It is systemic stability. And systemic stability almost always means protecting existing financial power centers. Another critical element is how financial elites use the law. They do not operate outside the legal system. They operate inside it, but at a structural level, not at the level of wording. When regulations change, they have already positioned themselves. When rules tighten in one jurisdiction, capital moves elsewhere. Legal borders become tools, not barriers. This creates a deep asymmetry between financial power and political power. Politics is bound by territory. Finance is not. A parliament can pass laws within national borders. Capital can leave those borders with a few keystrokes. That flexibility keeps governments permanently on the defensive. Financial tycoons do not need to win every confrontation. They only need to prevent decisive action against them. Policy uncertainty is bad for productive investment, but it is good for large financial institutions. When small businesses hesitate and long-term projects stall, capital flows towards what is perceived as safety, usually large financial entities. This is how power reinforces itself without open confrontation. Another underappreciated mechanism is intermediation. Financial elites are not always the final lenders. Often they arrange, guarantee, and distribute risk. By standing in the middle, they collect fees, gather information, and most importantly, control flow. The intermediary sees the whole picture. Each counterparty sees only their piece. This aggregated information allows them to anticipate trends earlier than the market. Absolute accuracy is not required. Being early is enough. In finance, being slightly early is the difference between power and reactive survival. In both Europe and the United States, financial elites also invest heavily in shaping mindset, not through direct propaganda, but through economic frameworks. Concepts like financial stability, market confidence, and fiscal discipline sound neutral, but they consistently shape policy in ways that favor creditors over debtors. Language creates policy reality. Another key dynamic is the relationship between financial elites and major crises. When the system functions smoothly, they are praised as efficient capital allocators. When crises erupt, they are condemned as greedy. Yet after the crisis, they often return stronger. Not because they avoid mistakes, but because the system is designed to absorb their mistakes and distribute the consequences across society. Profits are privatized. Risks are socialized. This is not a slogan. It is a mechanism. Financial elites do not need to control everything. They only need to ensure that when the system is threatened, they are among those protected first. History shows this pattern repeatedly. Another force reinforcing their power is complexity. The modern financial system is complex enough that most of the public cannot follow it in detail. This creates a massive information gap. When financial decisions are presented as overly technical, they escape meaningful democratic debate. Power is exercised quietly. Financial elites do not need to hide their existence. They only need to ensure that their mechanisms are difficult to understand. In such an environment, accountability becomes blurred. When things go well, no one asks who benefits most. When things collapse, no one is certain who bears ultimate responsibility. This is ideal terrain for long-term financial power. This second section shows that the power of European and American financial tycoons does not reside in specific individuals, but in system design, a system flexible enough to adapt, complex enough to evade control, and essential enough that it cannot be dismantled. In the next section, the focus will move deeper into the relationship between financial elites and major crises, and how each crisis reshapes the balance of power towards greater concentration. The rise of financial dynasties, the names that never make the headlines. European and American financial tycoons. Part 3 of 4. Financial power does not grow through direct confrontation. It grows through time, patience, and the ability to survive every cycle without taking fatal damage. If the previous section revealed how financial elites operate within the system, this section goes deeper into a core question: why, after every crisis, they don't weaken, but instead emerge even stronger. The first thing to understand is that crises do not destroy the financial system. Crises simply restructure ownership within it. Those without enough capital, liquidity, or patience are forced out. Those who possess all three remain and acquire what's left at prices far below real value. Financial tycoons do not seek perfect stability. They seek survivability in instability. That difference changes every decision they make. While society fears volatility, volatility is their natural habitat. When markets are stable, profits are distributed more evenly. When markets are chaotic, profits concentrate, and power always follows concentrated profit. A long-term strategy of European and American financial elites is controlling system choke points rather than the entire system. They don't need to own everything. They only need to own what, if stopped, causes the entire flow to seize up. These choke points include payment banks, clearing institutions, risk pricing entities, credit rating agencies, and key capital markets. Whoever controls the choke points doesn't need to issue commands. The system adjusts itself in their favor. This explains why many financial tycoons rarely appear in the media. They don't need visibility. They operate behind the daily mechanics of the economy. Their absence from headlines is proof they are doing their job correctly. In the United States, financial power is anchored in capital markets. In Europe, it is rooted in banks and sovereign debt. But in both systems, elites don't compete with governments. They make governments dependent. When a nation must borrow to sustain its bureaucracy, fund social programs, or refinance old debt, lenders no longer need formal political authority. They already possess real power. Once debt reaches a certain scale, the borrower has no real alternatives. At that point, power no longer resides in votes. It resides in loan conditions. Another defining trait of financial elites is that they don't oppose regulation. They welcome it, especially complex regulation. Complexity raises barriers to entry. Small players are eliminated. Large institutions survive. Modern finance isn't controlled by lack of laws. It's controlled by too many laws. Only organizations with massive legal, accounting, and operational capacity can endure. This creates a paradox. Financial reforms meant to reduce risk often strengthen the largest institutions. The tighter the rules, the greater the concentration. After every crisis, the number of banks shrinks, but the remaining banks grow larger. Power doesn't disappear, it changes hands. Financial elites understand this perfectly. That's why they don't fear reform. They only need to ensure they remain among those considered too big to remove. Another critical weapon is influence over macroeconomic thinking. They don't need to manipulate public opinion directly. They shape how policymakers think. When the dominant framework assumes growth requires debt, stability outweighs deep restructuring, and markets know best, financial power is protected at its foundation. These assumptions didn't emerge by accident. They were built over decades through academia, reports, conferences, advisory firms. Once an idea becomes standard, it stops being questioned. And when no one questions the framework, power operates silently. Financial elites don't need to control governments. They only need governments to respond predictably. When markets panic, governments inject liquidity. When systems shake, governments bail out institutions. When debt explodes, society tightens its belt. Repeat this pattern long enough and it becomes reflex, and reflex is power. A rarely discussed dimension is how financial elites weaponize time. Politics demands quick results. Finance does not. They can wait 10 years, 20 years. They invest in structures, not events, in long-term cash flows, not short-term wins. While governments rotate with election cycles, financial power compounds across generations. This is why many financial dynasties outlast modern nation-states. Governments rewrite constitutions. Dynasties rewrite ownership structures. In this world, elite stability doesn't come from morality, it comes from design. A system designed where failure doesn't mean elimination, only restructuring. When a major financial institution stumbles, it doesn't collapse like a normal business. It gets merged, rescued, recapitalized. Names change, power remains. And each cycle leaves the system more concentrated, more complex, and harder to challenge. One thing must be made clear. Financial elites are not movie villains plotting in dark rooms. They don't need conspiracies. They simply understand system logic better than anyone else. They don't break laws. They understand them deeper. They don't manipulate markets. They design products aligned with how markets react. In a world where everything is priced in money, whoever controls cash flow controls choice. And when choice is constrained, freedom becomes a formality. This section makes one truth unavoidable. The power of European and American financial elites does not come from fame or wealth alone. It comes from resilience, the ability to survive, adapt, and grow under every scenario the system produces. They don't need to win every battle. They only need to ensure that after every crisis, they are still standing. And more often than not, they're standing higher than before. The next section escalates the picture further into the relationship between financial elites and global crises, where power is not just preserved, but redistributed on a historical scale. The rise of financial dynasties, the names that never make the headlines. European and American financial tycoons, Part 4 of 4. When financial power becomes large enough, it no longer merely reacts to crises. It begins to move alongside them, not in the sense of creating chaos, but an understanding that crises are an inevitable phase in the global redistribution of power. Every major crisis in modern history leaves the same signature behind. Economic power is not erased, it is transferred, from many hands into fewer ones. And those standing ready to receive it are almost never newcomers. They have been preparing for a very long time. Global financial crises, sovereign debt crises, currency crises, energy crises, geopolitical shocks. On the surface, they look different. At the core, they all produce the same effect. They reveal who truly controls capital flows when the system starts shaking. In those moments, governments are forced to act faster than usual. And when speed is required, deep restructuring becomes nearly impossible. Leaders choose to save the system first, and the system that gets saved is the one already holding financial power. This is when the relationship between the state and financial elites becomes impossible to ignore. Not a relationship of command and obedience, but one of mutual dependence, structured in a deeply asymmetric way. The state needs the financial system to maintain social stability. The financial system needs the state to guarantee legitimacy and survival. But in a crisis, the side that controls liquidity always holds the advantage. Decisions made during crises are not made under ideal conditions. They are made under fear, pressure, and extreme time constraints. And it is precisely under these conditions that financial power is most effective. Bailout packages, liquidity injections, and guarantee mechanisms are not just technical tools. They are instruments of redistribution. They shift risk from the financial sector to the public sector. And once risk is socialized, financial power becomes more entrenched. After every major crisis, the financial system becomes more concentrated. Fewer institutions, but larger ones. Fewer players, but deeper influence. This is not an accident. It is a predictable outcome. One critical realization is that crises do not weaken trust in the financial system. They strengthen its position as irreplaceable. When people lose jobs, businesses collapse, and public budgets are strained, the question is no longer whether the financial system should be saved. The question becomes what happens tomorrow if it isn't. And within that question, the only option labeled responsible is preserving the system. Financial elites understand this psychology perfectly. They don't need to apply pressure.
They simply need to exist as an indispensable pillar. When you are the pillar, you don't need to speak. All decisions automatically revolve around you. Another deep consequence of global crises is the reshaping of rules. After crises, new regulations are introduced, but these laws rarely dismantle existing power structures. More often, they legalize what already happened during the crisis. Temporary rescue measures become permanent tools, exceptions become precedents, and precedents become norms. Over time, this creates a system where large-scale risk is encouraged because failure no longer means elimination. When you are big enough, you do not fail in the traditional sense, you are restructured. This fundamentally alters behavior across the entire system. Risk does not disappear, it concentrates at higher levels. And when risk is large, the cost is larger, but the people paying the price are rarely the ones who made the decisions. At an even deeper level, global crises reshape relationships between nations. Countries that host the core of global finance gain overwhelming advantages. Their currencies become safe havens. Their government bonds become the definition of safety. This allows them to borrow more cheaply, spend more freely, and project financial influence far beyond their borders. Other nations pay higher prices for the same level of risk. Financial power, therefore, is not a domestic issue. It is structural to the global order. Financial dynasties and major institutions do not need to control territory. They only need to control cross-border capital flows. And when those flows are denominated in strong currencies, power travels with them. One often overlooked effect of crises is how they reshape social psychology. After every crisis, societies become more risk-averse, more fearful. And in that fear, people are willing to accept concentrated power in exchange for a sense of safety. This is the invisible cost of stability. Freedom of choice is traded for order. Diversity is traded for predictability. Financial elites do not impose this trade-off. They simply offer solutions that align perfectly with that mindset. When people seek safety, they turn to large institutions. When they turn to large institutions, those institutions grow larger, and the loop reinforces itself. At the end of this chain, financial power becomes embedded into the structure of society itself. It is no longer a group of individuals. It is woven into laws, markets, habits, and patterns of thinking. And when power becomes structure, challenging it is no longer a matter of confrontation. It becomes a matter of rebuilding the entire system. This is why financial dynasties endure, not because they never make mistakes, but because their mistakes are absorbed by the system they helped design. In this framework, crises are no longer accidents, they are mechanisms that refresh the system while deepening power concentration. This final section does not argue that financial power is good or evil. It simply states a reality. In the modern world, power does not disappear during crises. It changes form, and it changes hands. And if this reality is not understood, every future crisis will continue to be told as a shocking surprise, while for those who truly hold power, it is simply the next chapter in a very familiar cycle.
Follow, subscribe, and share the channel to gain new knowledge and grow every day.